Life Insurance and Taxation Module Exam Prep Summary. Needs Analysis and Policy Selection. Temporary versus permanent needs. When reviewing a couple's financial obligations like daycare, mortgage, and spousal support, these all represent decreasing needs that are temporary. For temporary needs, decreasing term insurance is suitable. However, this type of policy is not suitable for covering final expenses because the date of death is unknown, and final expenses are a permanent need. For final expenses or estate issues, the only answer is permanent insurance. Business planning and succession. In a business partnership with no will or buy-sell agreement, the biggest risk upon the death of a co-owner is family interference. If the deceased partner's spouse, who lacks business knowledge, inherits the share, they become the new partner. This lack of direction can lead to tension and potentially cause the business to collapse, as creditors and loss of skills are generally manageable, but family interference is the immediate major risk. Estate preservation for spouses. For married couples concerned about paying taxes on high-value assets like RRSPs and joint rental property upon death, the goal is estate preservation. Since a spousal rollover allows assets to pass tax-free to the surviving spouse, taxes are deferred until the second person dies. The best solution is a joint last-to-die permanent policy on both spouses, which pays out tax-free cash only after the second death to cover the resulting tax liability. Term insurance should never be used for estate preservation. Determining the required coverage amount. To determine how much additional life insurance a client needs, you must first establish the total required coverage and then subtract coverage that the family will receive. For a client needing $2 million in total coverage, if they already own $600,000 personally, that amount is applied against the need. However, a $500,000 corporate-owned policy is excluded because the corporation, not the family, is the beneficiary and receives the death benefit. Similarly, group coverage that will be terminated, example, due to a job loss, must also be excluded. Therefore, the additional amount of insurance needed is $1.4 million, $2 million minus $600,000. Income replacement approach limitations. When a client only needs income replaced for a specific time, such as until they reach age 60, the income replacement approach is not appropriate. The reason it shouldn't be used is that it incorrectly assumes the income needs to be replaced in perpetuity, forever. This method would result in buying more insurance than necessary, as the capital generated from the death benefit would be larger than required for a limited period. Policy calculations and taxation. Taxation formulas and principles calculating taxable policy gain on surrender. When a policy is surrendered or a loan is taken, the resulting policy gain is taxable. The first step in calculating the taxable gain is to determine the proceeds of disposition, POD. The POD is the cash surrender value, CSV, minus any liabilities against the policy, such as the outstanding policy loan, accrued interest, and any unpaid premiums. The policy gain is then calculated as the POD minus the adjusted cost base, ACB. The amount of the gain is what must be reported as taxable income. For example, if the POD is $40,920 and the ACB is $30,000, the taxable policy gain is $10,920 tax recovery on loan repayment. If a policy owner pays a loan back, they can deduct the amount of the previous taxable policy gain from their income. When the loan was initially taken, the portion that exceeded the ACB was considered a taxable gain. By repaying the loan, the client essentially recovers the taxes they previously paid on that gain. In a case where the initial taxable gain was $10,000, the client would be able to deduct $10,000 from their income tax. Taxation of policy dividends. When a client chooses the cash dividend option, the dividend is considered a return of capital, and the ACB is tax-free. The amount that must be reported as a taxable gain is the difference between the dividend amount and the policy's ACB. For a $10,000 dividend with an ACB of $4,000, the taxable gain is $6,000, which the client must report and pay tax on calculating life insurance needs using after-tax income. To calculate the amount of insurance needed using the income replacement approach based on after-tax income, you must first find the after-tax rate of return. This is done by taking the assumed rate of return, example, 4%, and multiplying it by 1 minus the marginal tax rate, example, 1 to 0.44. This gives you the after-tax rate, example, 2.24%. You then divide the desired after-tax income, example, $65,000, by this after-tax rate of return to find the required coverage. Determining the net death benefit for universal life. When a universal life, UL policy with the level death benefit plus account value option out, the benefit is the sum of the face amount and the account value, the final amount received by the beneficiary. The net death benefit is calculated as the assets minus the liabilities. The assets include the face amount plus any extras, such as the account value. The liabilities include any outstanding policy loans and the accrued interest on those loans. For example, if the combined asset value is $675,000 and the loan plus interest is $106,000, The net death benefit is $569,000. Underwriting, policy provisions, and riders. Underwriting and policy validity conversion and attained age. When converting a term policy to permanent insurance at the original age, the premium is based on the insured's age when the original term policy was purchased. When converting at the attained age, the premium is based on the insured's current age at the time of conversion. Insurance companies using the age nearest rule will round up to the next age if the person is within 6 months of their next birthday. Types of partners. In a business where individuals are personally responsible for the business debts and obligations, they are operating as a partnership, and those individuals are general partners. An individual who only invests capital and is not involved in day-to-day operations nor personally responsible for debts is a limited partner. A limited partner's exposure is restricted to the amount of money they invested. Riders and supplementary benefits. Policy riders explained. Riders are typically used to increase the death benefit upon the death of the insured. Supplementary benefits are used to provide additional benefits to the insured while they are alive. Examples of supplementary benefits or living benefits include accelerated death benefits for terminal illness and premium waiver riders guaranteed insurability benefit. For a client with a temporary term policy who expects their future insurance needs to grow, example, buying a house, having children, the best option is the guaranteed insurability benefit, GIB rider. The GIB allows the client to buy additional chunks of insurance in the future without medical evidence. This is superior to the accidental death rider, which only pays out if death is by accident, or paid-up additions, which is a slow accumulation process. Convertibility option. To ensure a client's permanent needs are covered beyond the expiration of a 20-year term policy, the best rider is the convertibility rider. This rider allows a client to convert the term coverage to a permanent policy without medical evidence when the term expires. This is crucial because term insurance is only valid for the specified period, and the rider's term cannot be longer than the base policy. Group insurance vulnerabilities. The common belief that group coverage from an employer is sufficient is often flawed. A key vulnerability is that the amount of coverage is often quite limited. Furthermore, the premiums upon conversion are not guaranteed and could be astronomically expensive if the policy is converted after leaving the employer. Most importantly, the employer maintains control over the plan and can cancel it, leaving an uninsurable client without coverage. However, one thing the client does not have to worry about is the claim being refused due to post-claim underwriting, because there is no post-claim underwriting in group insurance-specific policy product features. Universal life death benefit options. Universal life, UL policies offer various death benefit options. The level death benefit option maintains a constant face amount, resulting in faster growth of the investment cash value because the net amount at risk for the insurer remains the same. The level death benefit plus account value option causes the death benefit to increase over time because the account value is added to the face amount. This option should be chosen if the client anticipates their insurance needs will increase in the future. Options for cash access. A client with a participating whole life policy who is concerned about having paid too much in premiums can access their cash value while alive in a few ways. They can surrender parts or all of the policy to receive some of the cash surrender value. They can also borrow money against the policy with a policy loan. Finally, they can change the dividend option from paid-up additions to cash, which would result in receiving a check every policy anniversary. UL tax-exempt status. A universal life policy can be either tax-exempt or non-exempt. Policy is tax-exempt as long as the cash value is equal to or less than the maximum taxable actuarial reserve, MTAR. If the cash value exceeds the MTAR, the policy becomes non-exempt. To restore the tax-exempt status without reducing the death benefit or incurring an increase in mortality cost, the client must move the excess amount of money into a side fund or side account. This must be done within 60 days of the policy anniversary to prevent the policy from losing its exemption status forever. Final expense and income calculations. Total coverage for final expenses and debts. To determine the amount of insurance needed to cover final expenses and debt, you must calculate the total liabilities and subtract the readily available liquid assets. A client with $100,000 in debt and $10,000 in final expenses has a total liability of $110,000. This liability is offset by liquid assets such as the maximum CPP death benefit of $2,500, cash in a checking account of $3,000, and Canada savings bonds of $20,000, totaling $25,500. Therefore, the amount of insurance needed is $84,500, $110,000 minus $25,500. Income needs with lost benefits. When calculating the income a family needs to maintain the same spending power after a death, you must factor in the loss of employer-provided benefits. If the insured's take-home pay is $5,000 a month, this equals an annual after-tax income of $60,000. However, if the employer was also covering $1,500 in annual dental costs and $2,500 in annual medical costs, That's an additional $4,000 in lost benefits that the family will now have to pay for. Therefore, the needs analysis must be based on a total income of $64,000, $60,000 plus $4,000, to ensure the family can maintain their current lifestyle. This concludes the detailed review of the exam preparation content. You should now have a strong foundation in these key concepts and calculations for the exam.